Welcome to the live stream. It's Friday as always, and I'm looking forward to our session today, just like I always do. I'm sure we're going to have a lively discussion. Excited for those of you that are here. Hopefully, we'll get a few more coming in as we get things rolling. Really quickly, just want to drop a reminder about the Discord server. Remember that this has been reorganized just a little bit in the last week or so, just to try to make things a little bit easier to get to. As lifetime members of the Rebel Income community, you have access to everything in the Rebel Income Plus Access category. And that is, oops, sorry. Give me a second here. Let me pull up my drawing tools. There we go. That is everything in this lower third, I guess, of the server. You're going to find the trade alerts for every Tuesday under the trade alerts channel. The link for this live stream will always be under live-webinar, and you can also feel free to please make use of the open discussion channel. If you have questions for me, for the group, I designed the open discussion channel just to be an area where we can all communicate and collaborate with each other a little bit about some of the things we're seeing in the market, things we're seeing with currently open positions and trades that you've seen me highlight. If you have questions, you can certainly post them there. I watch, I watch this area of the server throughout the day and will be able to respond to messages directly that way. If you prefer to reach out to me personally, you can send me an email address. I've dropped my email address in the chat area of this live stream, which is rebelincomesystem@gmail.com. You also can message me directly through Discord just by selecting the individual from your friends list and sending them a message. And so you can also message me directly that way. Okay. With that said, that's enough for the housekeeping items. Everything else in the Rebel Income Free Access this is all information that I'm making available for free to all members that have joined the Discord server. And so the reports, the articles, the early access area, those are all available for everybody. But if you want the actual trades, you want to download my ebook, etc., then you need to do that through the Plus Access, and that requires a paid subscription. If you're in this webinar or if you're viewing this live stream live, then you're a part of it. If you can access trade alerts or live webinar, any of these other channels, then you have access. Okay. Since it is Friday in the markets, that does mean it's expiration Friday, which naturally means that there's option contracts that are set for expiry today. And so it's not just that the market is open and so there's market activity going on, but also a lot of activity going on with some of the options that we're paying attention to and some of the positions that we currently have. We're going to start by looking at a couple of the positions that I do have on deck set for expiry today. Let me go over here to my track record really quick. The first one that I want to talk about is a put sale that I placed earlier this month on MDT Medtronic, selling the $82 strike price with an expiration date of today. There's also covered call on deck for Lamb Research, which is nice for those of us who got into that position earlier in October. So we'll take a look at those and hopefully have some time to look at some of the other positions that we're waiting on, and possibly even to open things up for review and analysis of some of the stocks that you may be interested in as well. So let's start here with Medtronic. As I mentioned, I sold the $82 strike price, brought in a little under 1.5% on this one in terms of the total premium that I brought in for about a 2-week period. That's okay. I'm really shooting for an average of about 1.5% per month. So to get 1.43%, just a little under that for 2 weeks, the math in the long term works out pretty nicely. And so that was a more than useful enough trade to place. And we can see the stock has really surged this week and is well above. We see really the bullish activity on this one really accelerating quite a lot. And so the strike price I sold is all the way down here at 82. So unless we see a major collapse in the next few hours, it looks like this option is going to expire worthless, which is okay. That's a satisfactory result by any measure. The other one that I mentioned, and if you have a different kind of number for what your result was if you placed the same trade that I did or a comparable trade, let's compare notes. As you know, I like to give out a salute for those who do a little bit better than me. So feel free to put your numbers in and let's compare. The other position that I mentioned was Lam Research, so LRCX. Oops, I can type. This is a stock that I was assigned. Barry, you're not in this one. Okay, and that's okay. Thank you. For some people, that trade may just not have worked out. I actually had to on Medtronic had to try this twice. I highlighted it on 2 different occasions as a potential trade. Let me go back here to our trade alerts. Oops. And this is the one. This is the trade that. Right. We'll get back to Lam Research here in just a minute, but here this is the alert. Oops. Why did that? Okay, there we go. This is the alert that I placed, the alert that I published with the trade that I was able to place. But we can also see, if I go back here a little bit, here's another one in late November that I placed that never actually got entered just because activity in the stock was not high enough. There wasn't enough open interest or volume going on to make the trade practical. And that happens sometimes. It changed enough by the first week of January that I was able to work with the stock. And so that's sometimes, just because we weren't able to place a trade on a stock at one particular period of time doesn't mean that you can't do it again later on. That's what happened in this case. LRCX. Okay. So Barry says that he's in Lam with an $83 call expiring today. So you sold a little bit higher strike price than I did, Barry. My strike price on this is 81. I was assigned on this. Go back here a little bit. Here we go. Here's the original trade back in the beginning of the second week of October. I was assigned at $80 and brought in about 2.25% on that put sale. That was a nice trade, but shortly after that put sale, the stock did this and this and kind of struggled down here around 70 for quite a while, not quite getting close enough to 80 to be useful. until really just recently. And so it looked a couple of days ago like I was going to get called out of my covered call on this. I sold. Go back up here. I sold the $81 strike, so I went a couple of dollars lower than you, Barry, bringing in $1.23 on this, 1.5% for 2 weeks of time. That was a nice covered call trade. I like it because it gave me an opportunity to bake in a little bit of capital gain on top of the income that I was able to bring in. It looks the stock is certainly it's lower today, and excuse me, would really need to reverse some pretty strongly bearish momentum today. There's looks like there's quite a bit of profit taking, maybe ahead of the earnings report here that is going to be coming up next week. So unless it reverses that pretty strongly today, it looks like my covered call is going to expire. Barry, so is yours. You made the trade about 8 days ago when it jumped. So you took advantage of this nice little surge, right? And got a pretty nice boost in the meantime, selling the $83 strike, and you're seeing it come back again. So it looks like we're both going to be coming. We're going to both be holding on to the stock. Barry did do better than me. Just to be clear, you brought in $1.30 on your covered call with the 83 strike price, baking in the potential for a little bit more capital gain if you get called out. Whereas in my case, I baked in $1. And yeah, Barry, we're going to get to do it again, right? That's nice. But you did a little bit better than me. You also brought in a little bit more income than I did with a shorter period of time. You had about an 8-day expiration. I had about 16. So you cut your trading frequency on this in half compared to me. So that's nice. I like that. And that's why you get a salute. That's nice. You did a little bit better. And I like it when everybody in the Rebel Income group can do a little bit better than me on these trades. Don't expect you to place the same trade or be a robot. Try to mimic my results exactly. I'm looking for you to be able to use this information in a way that's useful for you, and that you'll be able to find a way to make an adjustment or a modification that suits you better. So Barry did a great job, and that's what kind of thing we're looking for. So that's a really nice trade. And as Barry has said, does look like those covered calls are going to expire. I'm okay with that. This has been a useful position, even with all of this going on from November and December. It's a really good company in an area of the semiconductor industry that I think is really, really useful. And this is really kind of a consolidation range that is not really all that scary, even though the price is a little bit volatile. You've got movement from between about 70 to about 78, so a little over 10% in that time. So you're watching the stock swing quite a bit from one period to another, but that's not necessarily a bad thing. Barry, this is my fourth call since being assigned, brought in a total of almost $500 in income just on LRCX since being assigned. And that's what these consolidation periods create, are opportunities to do that. So congratulations, Barry. That's another one. That's just taking advantage of what the market is doing. This is why and what you're talking about, Barry, is exactly the reason that I refer to covered calls and put sales as the low-hanging fruit of the market, because these are trades that are just sitting there waiting to be made. Let's go to LRCX and look at a few examples. Let's go to our options chain. Here we go. Close out today's expiration. And here's some calls. I mean, look, let's just assume for a moment that, excuse me. Let's just go ahead and assume for a moment the price on Monday for LRCX has not changed from where it is today. That may or may not be true. I'm just going to try to simplify the story a little bit here to make it as easy to illustrate as possible. So if we make that assumption, then the question becomes what kind of a covered call might be available Monday, Tuesday. You'll see me if there's something that is still available on a covered call for this stock on Tuesday, then you'll see me included in the trading alert that I publish on Tuesday. But look at this is just the next 1 week of expirations. Oops, sorry. That is not what I was trying to do. That was okay. Let's be a little bit ambitious. Here's 83, which is where Barry liked to play. Right? And the bid price on this right now is $1.67. Now, this could be this could be pretty different by Monday. So we'll see if this holds water or not. But $1.67 on a stock that you were assigned at 80. I'm assuming, Barry, if I remember right, you were assigned at the same price I was. Yeah, that's fair too. Then you're getting a little over 2% for a 1 week period of time. Barry is saying, I'll probably wait until after earnings before looking at the calls and see where the price is. Now, the earnings report for LRCX is coming up on Wednesday. The 29th is when it's scheduled. And so there's some sense in what Barry is talking about. What we're seeing right now, this is a really good example of what happens ahead of earnings. We see, thank you, Barry, also in at 80. We'll see the implied volatility of options for stocks that are coming up on an earnings announcement typically become a little bit inflated. That's because speculation about what is going to happen around that earnings report start to increase. Oops, sorry, I'm trying to adjust my camera. So as those speculations run, people have different opinions about what a stock is going to do, and so you're going to see quite a bit of variation between the extremes, and that creates not only volatility in the stock, but more importantly, higher implied volatility for the options. Higher implied volatility for the options tends to inflate premiums. And when you get inflated premiums, what you get is really kind of a seller's market kind of environment. Now, if you're trying to take advantage of that ahead of earnings, you are taking a little bit of a gamble. And I say that because volatility is increasing because of uncertainty around those earnings reports. If you look at a stock around its earnings report and what it tends to do before or after, you start to see how variable it can be. Here's LRCX. Here's its August report. You can see immediately after that, it went up quite a bit. Here is its October report, and then it kind of went flat for quite a bit. Here's April, and then it went like this. So sometimes that's a positive, right? But it's hardly a given that just because we see a historical, maybe 2 out of 3 that were positive, that this one is going to respond favorably. There's a high degree of uncertainty, and the way that the market tends to react to earnings. It's a lot of times not even about what the last quarter was, but what management says about the next quarter ahead. And so the way that the market reacts to those earnings is part of the reason implied volatility increases. So Barry, you're making a great point. He says, I'd hate to rush into a trade on Monday for, say, an 81 call, and then on Wednesday or Thursday, the price jumps back up into the 82 or 84 range. or possibly even higher. And so there's a couple of things that you're doing. One, you're betting on a premium that especially if you're trying to get called out, may not actually happen. If the market takes the earnings information from the next report poorly, then you may still end up holding the stock for longer than you intended. Now, I don't mind that. I'm okay with that. But in other cases, that may be something where you just maybe are ready to unload and unwind a position and free up some of the capital that was reserved for that trade. And so maybe that's not what you want. To Barry's point as well, there is, and remember that when you sell a covered call, you're putting an absolute cap on exactly how much profit you're going to see. I sold the $81 strike price in this case. The fact that it's below that price right now is kind of more luck than anything. But if the stock had held its momentum up here from just a couple of days ago, it would probably be sitting around 83, 84, 85. Possibly higher if momentum were really starting to increase. And, here I am all the way back at 81. And this is the price that I would get called out at. So everything else between 81 and wherever the stock's price is going becomes a moot point. It doesn't even matter. And so that's one of the things you have to factor in to your analysis is whether or not that you're okay with that cap. Now, Barry is saying an 81 call with a nice premium looks pretty good if the price falls to the high or the mid 70s. You're right. And at let's see. Well, let's go with this one. Right now, here's 330. This is 2 weeks out. Oops. Go back here. Sorry. I got my buttons. Okay. Here's a 7 days out at 80, 292, 245. At 81, 246, it just changed. That's not horrible either. You're obviously, there's a difference of about 80 cents between the two different strike prices here. And at 81, 246 divided by 80, which is the price that I was assigned at, that's 3% for 3 days. So that's a really nice premium. And that's why even if the stock does push above 81, I would be okay with that. Again, I don't know that that's going to be where it is on Monday or Tuesday, which is honestly where I'm going to be really taking a hard look to see if I need to include that in in my trading alert for next week. But if it's still there, I may go ahead and do that. And if it's picking up some momentum above 80, at maybe an even a stronger argument for another covered call trade, even before the earnings announcement takes place. A lot of people will prefer just to wait until after. They don't want to try to deal with trades that cross an earnings period, and that's okay too. Whatever your preference is, just whatever your preference is, it will probably work out okay. But the nice thing about looking at these before an earnings announcement is the fact that these premiums do get a little bit inflated, and that works to the advantage of the sellers. And so that's why I really don't shy away from placing these trades, because again, talking about 3% for a 1 week period of time, that's unusual. That's something that you're not typically going to see, even with earnings coming up. So there's quite a bit of implied volatility going on with LRCX right now that looks pretty interesting. Hope that helps. But I do agree, Barry, if the stock drops down below 80 or just stays below 81, the 81 call at 246, that looks really, really nice. So we'll see where this goes. It is also useful just to look at the difference in premiums over time. So if we're looking at 81, you go out, remember we were at 245 for 7 days. Here we are at 287 for 2 weeks. Here's 3 weeks. Now we go to 325 and 4 weeks at 81, 370. So this is a really good example, really illustrative of the way that time decay accelerates as the stock gets closer to an option's expiration date. And so you're going to see a significant difference in the value of those options. So here's the 81 for today. Ask the bid price is 1 cent, which is about what I would expect. So Barry, looks like you're going to get called out on CTRA at 28.50. Well, that's not a terrible result either, is it? CTRA has really picked up a lot of momentum here, and that's given it gave it a really big boost from a low just before the start of the new year to from going from about 23.50 to almost $30 earlier. Well, to end last week, but it's been pulling back since then. It's a little bit above 29 today, so you're going to get called out. Hopefully that maybe that gives you a little bit of profit on the trade as well as whatever you brought in on the covered call. But got a lot of bullish momentum going on there right now. So been holding it since April assignment, 4th call. Nice. And this one doesn't have earnings coming up until mid-February. Sorry. So about the 20th, roughly. So we'll see what the stock does between now and then. It'll be interesting for sure. I don't have an open trade in this one right now, just because some of the metrics from the last earnings report had changed enough that the value proposition isn't quite high enough to warrant a new trade on this. But if you were in it from a previous one, that's this current momentum is a nice result. This is still a company I really like, even if I'm not placing a trade on it right now. It is still in my watch list. I'm keeping track of it. So if it cycles back into a nice price level, then I certainly won't hesitate to put it back in the rotation. Okay, so those are the trades that are on deck for expiration right now. Also have a couple of them that are coming up in the weeks ahead. Okay, Barry, your first call since May. Yeah, and at 28.50 plus a couple of dividends. You're right. And so bringing in, and this is one that pays a pretty good dividend at the stock's current price. Brought in about probably a little bit less than 5% just in dividends. 0.42 divided by 28.50. So 1.47%. That's just on the 2. So it's paying about 3% annually. Sorry, when I do math in my head, this is what happens. I get off. But that's about 3% annually, which is not terrible, right? Those are good dividends. And if you're with the other covered calls you've been able to place, depending on what your premiums were, you're getting called. It looks like you're going to get called out at the same price you got in at, but that may not necessarily be a bad thing. So with those additional covered calls, you should have a pretty acceptable result overall, I would expect. Okay. Again, let's just go back here really quick. 3 to be exact, for a total of 63, plus a little over 100 in total premiums. Okay. There we go. 3 dividends, to be clear. So, okay. Awesome. You're able to do a little over 2% in dividends overall, which means not retirement yields, but it is something. Now, again, you're at 3%. You're not quite to if you're looking at, for example, very short-term treasuries right now, you're getting a little bit above that, but um, you're also talking about an opportunity with owning the stock where you are able to sell additional dividends. So you're basically creating your own dividends by selling covered calls. And so you brought in $100 in total premiums with about $63 in dividend income. That's still pretty good. So let's do 163. Assume that you did 100 shares, right? It'll be 2850 is what you'd be dividing that by. So 5.71%. That's better than what you'd be getting with bonds. So yeah, just one lot. There you go. Okay. Conservative position, it was still productive. And remember, the objective with these is really to generate conservative income, not necessarily to shoot for the moon. And so we're going to have some that are going to work out a lot more aggressively. Some are going to provide much larger, bigger results, and some aren't, and that's okay. That's the ultimate goal is just to be able to see that coming in over time, and work from that basis. Okay, let's talk about gold for a second. That was the stock that I used for this week's put sale. Now I highlighted the $16 strike price when I highlighted the trade, and was able to actually sell a little bit lower when I went to place the trade on Wednesday, selling the 1550. Expiration was the 7th of February, bringing in about 25 cents. Barry, need a couple of those home runs because I'm tired of working. I feel you. I do. And to that point, if you are a member of Traders Pro, if you're a member of Jesse's community as well, then you're getting an opportunity to play some other kinds of trades. So if you have a couple of different buckets that you're working with, one maybe is rebel income and the more conservative stuff, and then you've got another one that is a little bit more aggressive with maybe some of the Traders Pro kind of trades, then you may be able to get a few of those home runs as well. So just food for thought. Okay, so let's just go ahead and take a look at gold. Oops, I meant Barrick gold rather than the precious metal. Now, in the interest of full disclosure, I've held this stock for a while, and the put sale that I highlighted is an opportunity for me to average my cost basis a little bit lower from where I was in the past. I'm in on this stock at. Sorry, I'm not pulling up the number. I can't pull the number out of my head immediately, so I've got to go to my records. My initial put sale on this one was at 2050. And so it was up here a little bit higher. It did get up in that area for a little while up here, and I was able to place a couple of good trades up in this area. It was never called out, however, and the stock has dropped since then again. Gold is kind of an interesting asset to work with. A lot of people kind of treat it as a hedge against inflation. If you want to work with the precious metal, I like to use the stocks as kind of a proxy for the precious metal. Barry went out a week on gold for a 1550 strike for a 0.36 premium, which is nice. I believe, Barry, you were probably able to place that trade a little bit before I did, because I've got a little bit more time on my trade. I've got about 2 weeks, and I didn't get as much premium at the same strike price. So I think you were striking a little bit more while it was hot, which is nice. That's a good result, and now you get another one. You got 3 of them. So good week for Barry. This is an opportunity to average from 2050 to about again, I'm trying to do math in my head. 1550 plus 2050. So if I am assigned at 1550, if the stock is below that strike price in 2 weeks, I'll be able to average my overall average assignment down to $18, which is not horrible, and a little bit easier to manage than seeing the stock up here in the 20s. See a lot more activity between 17 and 50 and 18. And so if I can get my cost on this a little bit lower, then this will be a little bit easier. Barry made his trade on Wednesday morning, so okay, you still got a better price than I did. Still were able to work it better than me, which I like. So I got 25 cents, 2 weeks longer. Yeah, 214. Oh, you're actually out a week longer than I. So when you said I went out a week, you went out a week further than I did. Okay. Well, still, that makes the higher premium a little bit easier to understand, right? You sold a little bit more time. Still, you did better than me. You got more premium. So we'll see how this goes. If I do get assigned, I like it here down here at this price. Barrick Gold is one of these companies that is just kind of really kind of a steady Eddie in the precious metals industry, and their stock price can be a little bit volatile, obviously, going from 21 to 15 in a pretty short period of time. So you do have to deal with that a little bit. But this is also a stock that I've used quite a few times over the past several years to really nice effect. And it's not a huge dividend payer. They do pay a useful dividend. It it's not earth shattering at 2.41% at the current price, but it's good enough. And I'm not chasing high dividend paying stocks necessarily. I'm just looking for dividends as a barometer for the quality of the company that I want to work with. And so Barrick is one that I've used quite a few times and have been pretty pleased with the overall result. There's been lots of opportunities with this one, not only to sell some covered calls, but also to do put sales at some of the lower extremes. I was able to do some put selling when the stock was down in this range. I have this one right now. And on a selective basis, selling additional put options on a stock that you've already been assigned at can be smart. The smartest way I like to think about this is if you're planning for, let's say, for example, that a normal maximum position size you may be willing to work with on a stock is 600 shares. And I'm pulling a number just out of the air here. If you want to be, let's say that's the maximum position size that you want to work with. If you want to take a more conservative approach because maybe you're a little bit uncertain about what the stock is going to be doing in the near term, maybe the direction you like the stock at the current price, but you think that it could also end up going lower, then there's a really good argument for doing what I'm about to talk about. This is called what a lot of people call legging or tiering into a trade. So maybe instead of selling six contracts right away to go to my maximum possible position size, maybe I sell two. So I break it up in three, or I do it in half. Maybe I do three or two, or even one, depending on what you want to do. The advantage that gives is that if the stock continues to, remember, I'm working with stocks that are primarily at the bottom of downward trends. That doesn't mean that they're ready to reverse. In fact, in a lot of cases, you're going to see that trend continue. So if it does, if you're taking this more conservative approach, then when it drops a little bit more off of the price that you were assigned at, maybe drops another 20% from the price that you bought at, maybe there's an opportunity there to sell another put option contract at a lower price, and then if you get assigned again, now you can start to average lower. Again, it doesn't completely minimize the risk of that downturn, right? But you are able to average in at a lower price than where you started, depending on how many legs you set up. Inevitably, the downward trend is going to reverse. That's true for all trends in the stock market. Every uptrend at some point is going to reverse. It's going to go back down. Every downtrend at some point is going to reverse and go back up. And so when the advantage of using this tiered system, this legging system, is that you will have been able to average your price lower to the point that compared to somebody else who maybe went in on a full position size at the very beginning. For example, let's say I went in with a full position size at 2050 when I was originally assigned my shares. If that was a full position at the time, then that's all I can do. All I can do is wait for the stock to get back to 2050. But if instead I'm using it as a leg of a larger overall position, then that drop sets up an opportunity to add additional shares without necessarily increasing risk, at least the planned risk that I had decided that I was willing to accept, right? Because if 600 shares is the maximum that I want to do, I'm averaging my cost lower. That's going to make it easier. Instead of waiting for the stock to get back to the original assignment price, instead of waiting all the way until I get to 2050, it's a lot easier to wait for it to get to 18 or 17 or whatever it may be that you're able to average down to by using this tiered system that I'm talking about. All right, I hope that makes sense. This is an approach that I'm really in favor of, especially if you are worried about the potential that the stock could continue to drop. Then make your initial trade even more conservative. Go with decide how to break it up, whether you're breaking it up in halves, in thirds, or something more. That way you can go in on a proportionate basis until you have a maximum size position that gives you a more manageable price to work with. Okay. So that's gold. Barry's got a little bit longer expiration than I do, but that's okay. The other trade that is on deck, this one has a later expiration, is Borg Warner. This was a covered call after being assigned this stock at 32.50. I sold a covered call first week of January. This was a little over a month. I typically try to stay within a month for every income generating trade I place, whether it's a put sale or a covered call. But with this one, I went out to 2/21/2025. That's primarily because Borg Warner does not have weekly options. And the January week 3 options the premiums weren't very high at all. And this was offering a little over 3.5% for a couple of weeks, or for about a 6-week trade. I'm trying to average about 1.5% per month, which means for 6 weeks, I'm at about 2.25%. So this put me well above that mark, and gave me an opportunity to bring in $1.15 of premium against my 32.50 strike price. I also brought in 75 cents from the original put sale. So yes, if this works out and I get called out, I'm going to be called out at exactly the same price I bought at, but I'll have these two premiums that I brought in, $1.15 and 75 cents, $1.90 divided by 32.50. That's a 5.8% result on a stock that I was assigned towards the end of November. And so I felt pretty good about that, and I still do. As of today, I would be called out. I've still got a little over a month to wait. Well, actually, I lie. I've got exactly a month, 3 days, 3 days less than 1 month. So I'm just going to call it 1 month to wait and see where this finishes at. But we've got a lot of, right now it's just kind of consolidating. It's got pretty strong resistance right at around the stock's current price. Has not been able to break it. We do see where support may be increasing. So we're getting a little bit of this wedge formation going on, and that could be a bullish catalyst to see the stock break above. And if it does, then I'll get called out. That's okay. Yeah, Barry, makes it a little more challenging with monthly options. And then also some of these have wider spreads between strike prices. Instead of maybe $1 at a time, you may be looking at $2.50 or even $5 at a time. And so those do become a little bit more challenging. You're absolutely right. As much as I can, I try to stay with weekly options. And I really prefer, obviously, dollar increments when I can find them. More and more stocks are working with those much more active increments, and so that makes it usually a lot easier. But for some of these, like BorgWarner, some of the others that I've worked with, Medtronic, that may only be working with monthly options. If the premium is there, if the opportunity is there, there's enough volume and open interest, I won't shy away from them. So, but you do have to understand, the different elements at play, right? Different dynamics, and be willing to account for those in a constructive way. I do totally agree with that. So thank you, Barry. Okay, got a little bit of time left here. There's a lot of stock. I've taken an increasing number of assignments over the last few months, and that's reflective of what market conditions have been like, really uh, since the start of the last quarter of 2024. And as a result, that means that I have a lot more positions that I'm paying attention to and looking for covered call opportunities for. Had a nice one with LRCX, but there's some others that have been going on. Barry, thank you. This is a good example of what we were just talking about in terms of monthly expirations or wider strike prices. He has one CRGY. Let's go ahead and pull that one up. It's held for a while, but it's sitting in no man's land between strike prices. He's in the money now, finally, but not so much opportunities for calls. So Crescent Energy, interesting. And let's see, do they have? Let's see what their option chain is. Oops, sorry, that was Apple. CRGY. All right, well, TradingView started to show options on certain stocks. That's what I was looking for there, but they don't have them for CRGY. So let's take a look here really quickly. There we go. Yeah, and here's another one. This is what the same kind of thing that we're talking about. They have monthly options. So here's 1 month out, 28 days, 4 weeks exactly, and 56, and $2.50 between strike prices. So you kind of have to deal with that. And that means that when the stock is got some momentum here, it's sitting at 16, but here's your strike prices, $15 and $17.50. So literally, I like the term you used was no man's land, Barry, and I think that's descriptive of what's going on here, because that's where the stock is. It's 16. I think I said it was 16.13. So you've got a nice movement right now, but certainly not enough to change what's going on at the 17.50 strike price. Certainly got nothing going on with the bid. So lots of open interest, which is interesting. Not a lot of volume though. With that much open interest, Barry, it might be your cost base is actually down to about $8 with previous call premiums and dividends. Okay, so you're still sitting on a 100% overall increase, which is nice. It would be interesting though here, considering the ask right now is at 30 cents. It might be interesting given the level of open interest. Again, not a recommendation to buy or sell. I'm just saying you could test this out a little bit. It's been a week since there's the last trade on this contract. So this may not work, even with the level of open interest. But what if you put in a covered call on this with a sell to open limit price at 25 cents? All you need is one person, or depending on how many shares you've got, all you need is a little bit of interest, and you've got lots of open interest. You might be able to get that. Probably have to wait for it, but you might be able to get it. So that's Crescent. Yeah. I hope that helps. Maybe it does, maybe it doesn't. But in the meantime, you've got your cost, your overall cost is down below any range that we've got for the stock, right? It's never been that low. You consider that, but just waiting to see if it's finished moving up. Well, it is pulling back, right? And so got a peak here a little bit below 17. Nothing wrong with setting a price that you're comfortable with. So who knows? Do what you will. All right. So I mentioned I have been taking quite a bit more in the way of covered call of assignments, and so For example, last week I took assignments on Nike and HRL. Nike at 74, HRL at 32. I've been trying to watch these over the past week to see if they recovered enough to offer a good covered call opportunity. And it looks like Nike might have one coming up. I'm not saying that I'm going to be placing a trade here for this one. You're reinvesting the dividends, even better. So you're getting additional shares on top of what you brought in when you first bought the stock. That's a good thing. So on Nike coming up on 74, let's take a look at the options chain on this. This could be interesting. Let's start out a month. 74, $1.91, 75, $1.45. $1.23 at 75 for 3 weeks. 88 cents, so just a little over 1% for 2 weeks. Enough open interest, right? Pretty good volume here. So those certainly look interesting. And $1.24 on a $74 stock that I was assigned at 74, 1.67 for about 3 weeks. That's interesting. I may go ahead and set that up on Monday. In fact, I'm going to go ahead and use these last few minutes. I'm just going to say it right now. If you're also in Nike as I was, then this looks like you've got a nice opportunity for a covered call. This only came up early in the last day or so, and that's kind of nice. When I looked at this yesterday, it didn't look this good. Here's Hormel sitting at around 30.84. This is the other one that I was recently assigned at 32. So we're still about $1 away on this one. And this, I don't, let me take a look here. Okay, so we do have weekly options at 32, 15 cents. Yeah, this is one where we're probably going to need to get a little bit closer to 32 just because there's not enough activity here on these ones to make a covered call, even at the same price that I was assigned at attractive right now. So I'll wait on Hormel, but Nike is looking interesting. So I'm going to take a look at this on Monday, and if conditions for Nike are about the same, then I'll enter a covered call trade on that. So we'll see where that lands. Huntsman, some of the material stocks have been showing some bullish momentum lately. Huntsman picked up a little bit and is pulling back the last few days. Now it's down around 17.35. I sold the $20 strike price here, so it's a little bit below. That's not close enough to be really practical right now. Comcast, I'm in at 44, and it's around 37.50. So again, wait and see. Barry, your Walgreens Boots Alliance 1250 calls look to expire worthless today. Got a lot of stocks that have been showing some bullish momentum. They're pulling back a little bit today. I think the market is self-correcting a little bit. You got some people taking profits, and that's okay. Walgreens, I think, is showing a nice little uptrend here. The 20-day moving average is the slope is starting to increase in a positive fashion. And if it can It's right now using the 200-day moving average as resistance, but if it can break above that again and hold it, there could be some continued upside. Yeah, just look for a new trade next week. I agree with that. Yeah. FMC showing a little bit of bullish momentum as well. Not enough to get back to the $60 price I was assigned at on this one, but certainly enough to let me just keep holding serve. This is another one with a useful dividend, not huge, but enough. 4.17%, actually a little bit more than the average. So that's good. And then let's see. Devon Energy, 39.50 was the price I was assigned at on that one. Had started to approach that price, would start picking up some good bullish momentum here. And again, it's kind of like Walgreens has been tailing back a little bit. CVS and KHC. CVS I was assigned at 64, KHC at 34. CVS is picking up a lot of bullish momentum, which is nice, but it is still quite a ways away from the $64 I was assigned. So we're going to need to wait and see if that lands. KHC I was assigned at 34, but it's dropped down below quite a bit and is kind of struggling to get above the 20-day moving average right now. So a lot of these, it's not that the price action is bad on these, but they're still far enough away that need to be willing to be patient, wait and take in the dividends as they come in and let the stock work itself out. Remember, this is what happens when you're looking at stocks in downward trends, is sometimes after you get assigned, you're going to stay in that stock. You're going to see the downward trend extend itself. Yeah, Barry, he has a $34 Southwest Airlines call expiring next week, in it at around 28. So again, you're positive, you're net profitable, and it could pick up enough momentum in the next 7 days, right? It's got earnings coming up Thursday. So if there's any kind of information leaking, could see some volatility on both sides on this one. I think there's enough drag on the airlines industry right now with Boeing that I'm kind of staying away from the industry right now. That's just me, but okay. All right. Thank you, everybody, for your time. I do appreciate it. Hope this has been useful as always. We'll be doing this again next week, obviously. If you have any questions in the interim, don't hesitate to reach out to me through Discord. You can do it in the open discussion area or message me directly there, or send me an email, rebelincomesystem@gmail.com. Thanks again. Hope you have a wonderful weekend, and we'll talk again next time.